Hi, everybody. Welcome to our second session on options. Today, we're going to be covering the cash covered put. So first, we cover the cash covered call. We're going to start assuming some of the basic knowledge we covered in the last video. So if you get lost, just go to YouTube, watch that video, then watch this video. Because we're going to move a little quicker through some of the basics in this video since we covered them in the last video. And actually, where we're going to go with this option series is pretty interesting. So while I theoretically understand options well, I haven't used them much in my own personal portfolio because I haven't had the need to per se. But actually, Sanjay has used options very significantly as a trading strategy. And so what we're going to do in the next session on options in 2 weeks is we're going to have Sanjay walk you through some of his real life examples of how you can use cash covered puts and cash covered calls to generate additional income for your portfolio.
Stock covered calls.
Covered calls, sorry. Covered calls to enhance your income in your portfolio. So let's continue with this session. So what we're going to cover today is we're going to describe the put option. So what is a put option? We're going to explore the payoffs of the contract to the writer and the buyer of the contract. We're going to discuss the concept of what a cash covered put is. We're going to walk through an example like we did on the call session. And we're going to discuss the pros and cons of the strategy and talk about when this strategy is optimal in the market and when you can really think of using it significantly. To generate additional wealth for yourself. So let's start with quickly recapping the basics. So again, an option is simply a contract between two parties. There's the writer of the option or the seller of the option, and there's the buyer of the option. So the buyer of the option is buying the right to do something in the future, and the seller of the option is agreeing to honor that contract in the future should certain conditions occur in the future. And so the buyer pays the writer of the option some money in return for doing that. So what that something is really what the type of option revolves around. If that's something that the contract is about is buying something in the future, then we call that a call option, which we covered in the last class. And if that something is selling something, then that's the put option. So now we're talking about a contract that binds two parties that deals with selling something at a fixed price in the future. So that's the put option. So let's understand this a little more concretely with just an example of an option transaction and the various parties and what happens. So we have the writer of the option, again, that's the seller, and we have the buyer of the option. So at purchase of the option, the buyer is paying the premium to the writer, right? Because he's buying the rights for that contract in the future. And the option writer in return is transferring to the buyer the right to sell shares at a fixed price, the strike price. So once the option expires, if the price is below the strike price, then what happens? Let's consider this. So essentially, because the price is below the strike price, the option has value to the buyer because he can sell the shares at a price higher than the market price, right? So the buyer basically delivers the shares to the option writer, and the option writer delivers back the cash proceeds of the strike price times the number of shares. So essentially what's happened here is the buyer has locked in a price to sell in the future. And he benefits in this case because the price he's locked in is higher than where the shares are trading in the actual market. And the option writer gets hurt because he is going to buy shares at a price that is more expensive than the market price. Now let's consider what happens if at the exercise date, if the price is above the strike price. Well, if the price is above the strike price, the option has no value because why would the buyer of the option sell his shares at a price lower than he could sell in the market. So nothing really happens to the option writer. The option writer basically collected the premium and he didn't have to do anything at the expiry of the contract. So the way you can kind of put this in your head, the option writer in a put would ideally like the price of the security to not fall below the strike price at exercise, and the buyer is going to benefit if from protection if the stock goes below, then the option has value. That's a little simplistic. There could be scenarios where the writer actually wants the option to get exercised, and the buyer obviously holding the stock doesn't want to see the stock price go down, but we'll cover that in a few slides. Okay, so now let's understand a little bit of the fundamental differences between the call versus the put. So because a call is a contract to buy and a put is a contract to sell, we can already draw some inferences around the difference around how these contracts are used. A call is all about dealing with the upside of a stock. It's about what happens if the stock price goes up. So the buyer typically of a call option wants to participate in the upside of a stock without owning the stock. And the writer is trading participation in the upside in order to capture a fixed income. A put is focused on the downside. What happens if the stock price goes down? So the buyer typically wants to buy some insurance on the stock. Let's say you owned a lot of stock and you were worried what would happen if the stock price fell. You were worried about the market. You were worried about something specific to your company. Let's say you owned Bharti Airtel stock and you see all this AGR ruling that's going on in the Supreme Court, and you're worried that that's going to go against the stock. If you want to buy some insurance, you can look at buying a put, and that will protect you from the downside should it occur. And the writer, he's capturing some fixed income and is willing to take the risk of a downswing. He's willing to own the stock if it falls in value. So that's kind of the dynamics that's driving a call versus a put. And using this page, you can, and the points on it, you can really think through, what do I want? Do I want a product that helps me think about what happens if the stock price goes up, or do I want a product that's going to help me think about what happens when the stock price goes down? That will tell you, do you need to be looking at call options or put options? Okay, so now let's actually take an example. So I pulled some data on a Britannia put. So we looked at a Britannia call last time. Now we're going to look at a put option. The share price, for everyone's reference, when I got this quote was around 3,850 rupees. I pulled this information from Money Control. You can pull it yourself. It's free to look at how options are priced. So again, we're just going to go through this a little quickly because we went through it in detail in the last video. But the key information I've labeled for you guys, the underlying stock. So that's the contract is dealing with shares of Britannia. You can find options on many large listed stocks. So you can find them on Reliance, for example. So we could look at Reliance contracts. Here we're focused on Britannia, a Britannia contract. So the next important data is, when does this option expire? When are we going to look at the price of the Britannia stock, and when is the option going to be valid to exercise? And that's what this expiry date is telling you. So here we can see that the option expires on the 24th of September, 2020. So basically in a month from today. And this PE that's here is just telling us this is a put option. Remember when we did the call option, this said CE. So that's just identifying whether it's a call or a put. And you want to make sure you really understand this. You don't want to mistakenly buy a put when you buy a call. So make sure to double check all the information before you start purchasing or selling options. And the last piece of information is the very important strike price. So that's the fixed price per share that we can sell our stock if we're buying the option, and which we're guaranteeing to the buyer of the option if we're buying the option. And then this big number in red is just the premium per share. So that's what the buyer needs to pay the option writer for the rights, for the value that he's giving the option buyer. So here we can see it's going to cost 33 rupees per share. And really quick, I'm not going to go through all these numbers because again, we went through them before, but the other important number to check is the market lot. This is telling you, so all of these numbers are per share. The strike price is per share, the price of the option is per share, but the reality is the smallest amount of shares that you can enter into a contract on are 200. That's what this market lot tells you. It tells you how many shares one contract covers. So here we can see that the minimum is 200 shares and you need to buy in multiples of 200. So that will give you a sense of how big a contract you have to deal with here. So, okay, let's take a look at the payoffs. So I've shown you two payoffs here. One is the payoff of the writer of the option, and one is the payoff of the buyer of the option. So the orange line is the buyer of the option. You can see that the buyer of the option starts having value to the buyer of the option when the share price falls below the strike price, right? It's 3,500 rupees. When we get below that and you subtract out the premium he paid, so he paid 33 rupees for the option. So when you actually get to 3,467, he starts being in the money, we call it. That means the option has positive value for him. His insurance starts kicking in, right? And the writer of the option is basically the exact inverse of that. So it's a mirror image. It's the reflection of that line across the x-axis. So here in blue is the buyer. So if the price closes above the strike price, then he just pockets his premium. How much of a premium? Well, basically it's going to be this 33 rupees per share times 200 shares. So that's going to be 6,600 rupees in option premium for him. So that's what you can see here. He's just collecting that premium regardless of where the share price is. But if it falls, then he's suddenly going to have to buy the shares at above market prices. That's why he's got a negative value to the option. One very important difference between a call option and a put option is that your losses are capped in a put option. Why is that? Because the price cannot fall below zero. So you can calculate the maximum loss you can take in a put option. So let's see what that number would be for Britannia. So this contract governs 200 shares. I know that if I'm writing a put option that I am agreeing to buy 200 shares for a price of 3,500 rupees on the 24th of September. If by some disaster, Britannia goes bankrupt in 24th September 2020, then my loss is going to be capped at that 200 shares times that 3,500 amount. So that's a 7 lakh loss. So that is the maximum loss I could take on the option. So that's a pretty large number, right? So remember, when you're dealing with options, they're highly leveraged instruments. So you want to be very careful about trading in options and making sure you understand what your losses are. In a call, it's even worse. The call, you can theoretically, if you write a call, you can lose an infinite amount because the share price can go up, in theory, up to infinity, right? So you want to be very careful when making sure you've done the analysis you need to do. Okay, so let's understand the potential motivations of the put transaction for both the buyer and the writer of the contract. So let's walk through an example of when a put would make sense. Let's say I owned a lot of Britannia stock. I felt very good about the company and I thought there was a lot of upside still left, but I was worried about market declines and I wanted to buy some insurance because I said, look, at the end of the day, I like this company, but I feel like, I don't think the market is necessarily reflecting accurate valuations. I want to buy some insurance in case the market goes down. I want to be protected. And I'm fine taking a loss up to 3,500. So I know the stock's trading at 3,850. If it goes down to 3,500, I'm okay taking that loss, but I want to be protected beyond that. So I'll buy a put to protect myself. So for 6,600 rupees, I can protect 7.7 lakh worth of stock. So how much is this insurance costing me? Roughly a little less than 1% of the notional value of the stock. So for 1% of the value of the stock, I can essentially buy some protection on my portfolio for 1 month, right? So that's the kind of motives that would drive someone to buy a put for their portfolio. It helps you manage the volatility of your portfolio. Now let's understand from the writer's perspective. Why would someone write an option on this? I like Britannia, the company. I'm willing to own the stock at the right price, but it's too expensive now. But I would buy the stock at 3,500 or below. And you're fine collecting your premium even if the stock shoots up. So if the stock shoots up, then it's okay. I'll just collect my premium. I don't think the stock is going to shoot up because I think it's expensive at the current price. But I really like the company. I wish I could buy it for a lower price, but I can't. So you earn 6,600 rupees in this case, right? Because that's the premium, the 33 times the 200 shares. And you set aside the money you need in case the option gets exercised, you need to buy the stock. You set that aside 100% to cover the put with the cash you need to allocate. So that's 7 lakhs. So if you take that 7 lakhs and look at the return you generated on the 7 lakhs, you generated 6,600 rupees on 7 lakhs of capital. So you'll earn close to 1% return in 1 month on your money. That's a pretty good return, right? You can't get that kind of return putting it in a savings account or anything, right? So that's kind of the motivations of the option writer. He likes the company's stock. It's too expensive for him to buy currently. He has extra capital lying around. He wants to earn a fixed income on it. So he's writing the put and he's collecting a very good interest rate on his money effectively by getting 1% per month at the current prices of the options. Okay, there's one wrinkle I want to walk you through. In the last example that we talked about, I talked about setting aside 7 lakhs worth of capital, right? Because if the option was triggered, then we had enough money to actually honor the contract and buy the shares. If you actually go to Zerodha, and we walked through what this is on the last video, but it's the Zerodha margin calculator, and you put in the details of this contract, what you'll see is that the actual margin requirement is much lower than 7 lakhs. It's actually 1,23,738 rupees. So if we calculate the returns on this capital, it's actually humongous. It's 5% return per month. Now, what is the flaw here in doing this kind of math? The flaw is that the value of the put will plummet and go up significantly based on movements of the stock. So you don't want to just look at this. In our view, you don't want to just plan on having the minimum margin amounts. You should always in your calculations factor in when you're writing a put, what if I have to buy the stock? I should set aside that money, make sure I have it, because otherwise you're taking a lot of risk in your portfolio that you may need to sell something to cover the collateral requirements of the put in the future. So we recommend you do not do this and basically put the minimum margin amount in the account. Okay, so that's essentially what I'm saying here. We can skip the slide, but basically the points we covered. Always, we recommend to avoid the temptation of being overly greedy. You can make a good, safe return. No need to take excess risk by just writing a put on an amount you can't afford if things go against you. Okay, so let's talk about some of the core principles of writing a put well. The first is you want to be writing on puts on stocks which you like, because there's always a risk that you're going to have to own the stock at a certain price. So you would be very amiss to write a put on a company that you didn't like to own, right? If I wrote a put on a company that I thought was terrible, that's not a really smart move, because what if the stock price falls and then I'm stuck owning that stock? You always want to actually like the company. You just don't like the price. That's the key when you're writing a put. I like the company, but I don't like the price. I like the company, but I don't like the price. In this way, you create a win-win situation. If the stock falls to a price that you anyway would have bought the stock, so what? You would have anyway bought the stock at that price. The option got exercised. You own the stock at exactly the price you wanted to pay, and you're not bothered. And if the stock doesn't go to that price, anyway, you thought the stock was expensive. So why are you complaining, right? You didn't want to own the stock at that price, and you're not owning it. You collected some income. So it's a great way to set up a win-win situation. And doing this is really key to making puts work for you. So when does this strategy really work really well? And the answer is a sideways market. And this was also our answer with the call. The truth of the matter is, when you're writing calls and you're writing puts, they are enormously profitable strategies when the markets do not move too much up and they do not move too much down. And the reason for that is that there's always an opportunity cost of writing an option. When I have 7 lakhs sitting in my account, either I can write an option for 200 shares of Britannia, or I could even buy Britannia stock, right? So, or I could leave it in cash. So now let's think which of these scenarios is best under what scenario. So let's say that there was a very bullish market and Britannia's share price went up and I wrote an option. Well, I missed a big appreciation in the stock price. So while I got my premium and I collected 1% on that capital in a month, maybe I could have collected 5% in that month if I had owned the stock, right? So in a rising market, puts tend to not be that great. It's better to actually own the stock. And in a bearish market, what happens is your put gets exercised. You're forced to buy it at the strike price, but the truth is the stock may have gone even lower than the strike price. So I'm buying it at 3,500 rupees. Maybe the stock goes down all the way to 3,000 rupees. So in that scenario, actually having your money in cash is better, because you would have been able to pick up the stock at 3,000 rupees instead of 3,500 rupees. But what happens when the markets are range bound and flat? Then premiums become very valuable to you, because you aren't leaving much money by not owning the stock, and you're not able to profit from low prices if you had your money in cash and you're earning only a savings account interest rate on it. Whereas in a put, you would be earning that 1% amount that we calculated. So the sideways market is a put writer's best friend. So when you're writing a put or a call, you really are making a bet on the economy or the stock market being range bound. You don't think there's too much risk. You don't think there's too much opportunity. So let's put it all together, right? We covered a lot. What's a cheat sheet for covered puts? You like the underlying and are willing to own it at a lower price. This is really important. The market feels like a sideways market. Low chance that the stock falls well below your strike price. Low chance that the stock will appreciate. Interest rates are low, but option premia are high. So that basically means, like in a scenario today, this is a very interesting time to be writing puts and calls if you're willing to take the risk of big market moves. Why? Because people are not sure if the stock prices are going to fall big time or they're going to go up, or what's going on in the market. There's a lot of uncertainty. So in those periods, people are willing to pay a lot for the contract that you're selling, because they want insurance, right? They want to be protected if stock prices fall. So that means just like basic supply and demand, the demand is very high for put options right now, but the supply is pretty low. So if you're someone that is got a view on the market, right, that it's maybe not going to go down all that much, you can actually earn a very high premium today, especially compared to what you can earn at a savings in a savings account, because interest rates have fallen, as we've all seen, right? Savings accounts are paying you 2-3%, not what they were before. So this is an interesting time to look at these strategies and think about whether you want to test them out. But obviously, you need to be careful. And you have excess capital that you aren't sure what to do with, right? You're sitting with your, in this example, 7 lakhs. It's uninvested. You don't want to buy stock, but you want to earn a return on it. Maybe an option is a good way to do that. Limitations and drawbacks of the covered put. So what are some of the issues with it? So like with the call option, the markets for puts are not very deep in India. There are not that many contracts and they're not traded that often. So there's a lot of leakage that happens when you buy and sell these, and brokerage fees can be expensive as a result because it's hard to market make these contracts. So you tend to pay a lot in fee and spreads when you're doing options. Equity markets by nature, as we discussed with the call option, over the long run tend to go up and right over time. So rather than essentially earning fixed income like you're doing when you're writing options, in the long run, it's better to actually own the stock. But there are times where it may be better to have an option strategy rather than an equity strategy. It's easy to get hoodwinked by the premium and forget that ultimately equity ownership outperforms in the long run, right? Margin requirements can be irritating and difficult to forecast. Like in the example we showed you, Zerodha is only asking you for 1 lakh margin. But tomorrow, if the stock price falls even 2%, that margin may increase from 1 lakh to 2.5 lakhs. So that's why, again, the best way to counteract this is always assume when you're writing the put that you need to set aside the full 7 lakhs of capital. That way you'll be assured that you won't need to put in more capital. And then option income is taxed as business income really, but that will have a higher tax rate than equity. So that's kind of the drawbacks. Now let's think about when buying puts makes sense, because buying puts is also a very interesting strategy. So typically you want to buy puts when you feel that markets are not properly pricing in risk. So let's give you an example of recent history. Now a discerning observer of the world could have made a lot of money and protected their portfolio if they had acted accordingly. So COVID develops in China. You think there's some risk that it'll create economic disruption. You're not sure, but you think there's some risk, right? Because this thing is spreading and you think it could spread globally. But markets haven't figured it out. It took a long time for markets to finally realize that COVID was a risk, and suddenly they reacted very quickly, right? So you had a lot of time to get ahead of the news. You buy some puts for a cheap premium. Buy the premiums cheap because no one's figured out that COVID is a risk yet. So they're not reflected in the price of the puts. So you bought the puts at a cheap price, and suddenly you were right. The risks were not appropriately reflected. COVID totally dismantled the economies. Stock prices went down big time, and your puts became very, very valuable. So this is how you can really profit from using puts in your portfolio. You have to look for times when risks are not accurately priced. And this is something I actually have done a lot of in my career. But my biggest use of options in my personal portfolio has been to buy puts when I saw that markets were not accurately pricing in risks for particular companies or broader economic disruption, and they can serve as very good ways to hedge. But the really important thing is the risks have to be mispriced. So why wouldn't we buy puts now on our portfolio? Well, we saw how expensive they were. just buying 1 month's insurance on your portfolio on Britannia is costing 1% per month, right? That's expensive. That is not a cheap insurance option. So when people have figured out there's risk, then option premia also become expensive. So it's best to do this when you find some asymmetry in how much risk you think is in the market versus how much risk is reflected in the price of the option. So people know right now that there's a lot of risk to stock prices. A lot of people feel that stock prices are too rich. And so a lot of people are hedging their portfolios with puts, and that's driving up the price of premia in the option space. So maybe a good time to write options, may not be a great time to buy options, or who knows? I mean, if you see a very sharp contraction in prices, even buying puts could make sense. But as I look at it, options seem pretty expensive to buy right now. And so with that, we'll open it up for any questions if you have any, and then we'll conclude.
Okay, so there is one question so far.
Sure.
Most important, the most popular option in India is on Bank Nifty. Can you talk about index options?
Yeah, so Bank Nifty, so index options are really not all that different than individual stock options that we discussed here. The only difference is the underlying, in that case, is the index and not the particular security. So here we're focused on where Britannia's stock price will be. When you're buying the Bank Nifty put options or writing the Bank Nifty put options, what you care about more is where the index ends up. It's a little more challenging to write index options because while I can do a lot of micro due diligence on a particular company and really understand that company well, it's very, very hard to have a differentiated point of view on a basket of, say 20 stocks, right? It requires a lot of work. And so it's harder to forecast where the index is going to be in terms of price than where individual stocks will be. But they can be very good tools to hedge your portfolio. If you own a lot of bank stocks, for example, and you want to hedge against price declines, then buying puts on the Bank Nifty can be a great way to do that. Or if you're bullish on banks, buying a call option on the Bank Nifty could be a very good way to make a general bet on the value of that index.
All right. I don't see any more questions, so I think we can.
Yeah, I'd just like to very quickly introduce what I will cover on the 6th of September, which is 2 weeks from now. So there is a lot of detail when you become an option practitioner that you should know. These 2 sessions introduced you very well to the theory, but the devil is in the details. So in my session, I will cover how I actually used options in a fairly big way. I mean, so I generated about premiums of about 4 lakhs in the month of August. So I'll talk a little bit about that and some of the things that you have to be careful of when you actually practically trade options. Okay. So that's it. Okay.
Yeah. It should be a great session. And I'm going to do more of these sort of practical sessions also. So most of my experiences in share investing, equity investing. So I'll walk you through some case studies also. I think it'll be a fun way to actually walk through real life examples of what can go right and what can go wrong and how to take learnings for how to analyze your own portfolio. So good stuff, guys, and we'll see you next week for the beginner series and in 2 weeks for the next series. There was one more question that came in from Leo. How much capital required to do options? So Leo, that's going to vary based on the contract that you write. Zerodha has a margin calculator. You can find the link to that in our last video on call options. It will tell you how much capital you need to set aside in your account. Like we said in this video, if you're writing a put, the margin calculator is going to show you a lower amount than we suggest you actually set aside. Here you want to, when you're specifically on puts, you want to calculate it per what we showed you. what is the maximum amount of capital that you would require? It's going to be the strike price times the number of shares. So that's a quick calculation you can do for the put option.
Yeah, so I'd just like to add to that, that if you are very new to options and you have never used options, then you should definitely get your feet wet only with covered call options, because you own the stock and you're trying to write a covered call on that. You will still need some capital because there is a haircut on the stock when you try and put it for margin. So, and you should just do one contract, get your feet wet, understand all the mechanics, and then move. Options are very dangerous, okay, if you don't know how to do them properly. So
yeah, I agree with that completely. They're very dangerous, but the best way to sort of learn is to do them with amounts that are really small, and make sure you understand what's in these videos thoroughly, right? Go through them over and over again, understand the payoffs for yourself, and go through Sanjay's real life examples in 2 weeks. And I think that'll give you the confidence you need. But Sanjay is absolutely right. One of the easiest ways to lose your short in finance is to mess around with options without understanding them fully. So because the losses can be quite astronomical. But we've given you the basics here. To avoid that, you just need to make sure you thoroughly understand these two videos and the next one that we're going to have. So with that, why don't we conclude? And thanks guys for joining. See you in the future.